Welcome. In this video, we will look at when the rise in XCN coin can start. Please watch to the end so as not to miss anything. First of all, when we look at the chart from a broad perspective, we can see that there is a clear downtrend. This trend shows that the price is exhibiting a downward trend by continuously making lower highs. When we examine the price action, we can see that it has touched this downtrend several times, and each time it does, it encounters selling pressure and moves down again. Falling trend lines often work as a strong resistance zone in the markets. So every time the price touched this trend, it faced selling pressure and retreated. However, there is an important point to note here. Each contact can reduce the price's sensitivity to the resistance zone, because in the markets in general, the more times a resistance or support level is tested, the more likely it is to be broken. Therefore, if the price approaches this falling trend line once again, there's a chance that it will face selling pressure as it did in previous attempts. This time, however, if a breakout with volume occurs, it means that it is now moving into an uptrend. And once the price breaks, it should also retest for confidence. But we cannot know if it can be bullish with only one trend, so we need to look at other metrics. Stay tuned. According to the Elliott wave theory, there is a structure that moves in waves in the market, and in this structure, 5 trend-oriented waves and then correction movements occur. When we examine the chart now, we see that the first wave has been completed, but the second wave has not yet formed. The first wave is usually the first strong bullish wave and represents the point at which the market rebounds from its bottom and makes its first significant upward move. This wave usually occurs at a time when investor interest in the market starts to pick up again. Buying picks up momentum and the market starts to break out of its downtrend. However, the first bullish wave is usually followed by a correction, which is referred to as the second wave. At the moment, we see that the second wave has not yet formed. This means that the price has yet to make a major correction. The second wave is a retracement, which usually follows a bullish move in the first wave. This wave represents a period of profit selling and some retracement by buyers. However, the critical point here is this. The second wave should never go below the starting level of the first wave. If the price falls below the starting point of the first wave, the Elliott wave structure is broken and this count is cancelled. Since the second wave has not yet formed, it is currently unclear when the price will start its correction. But if it does well in the second wave, it will qualify for the third bullish wave. One of the important structures to notice on the chart is the double bottom pattern, known as the W pattern. This pattern is generally considered to be a strong reversal pattern, indicating that a downtrend has ended and the price is preparing to make an upward reversal. Looking at the current price action, we can see that the W pattern is trying to complete. However, in order for this pattern to be fully valid, the price needs to make a new low by moving down from its current neck once again. The W pattern is named after the visual structure that the price draws. The price first makes a bottom, then rises, but gets stuck at a certain resistance point and pulls back again. The second retracement usually finds support near the first bottom, followed by a bullish move, completing the pattern. Currently, we see that the price is in the neck zone. If the price makes a downward move from here again, and turns up again near the previous low, this pattern will be valid. In order for the pattern to be completed, the buying from the second low should be strong and the price should break the neck upwards. If the price breaks the neck, then the pattern target would be an upward move by the distance between the bottom and the neck. Here we have to wait patiently for the pattern to be completed. Analyzing the price action, there is a strong bullish order block just below its current position. At the moment, the price is slowly approaching this zone, and if it reaches this level, and there is a strong buying reaction like before, the price may start to rise again. This is because in the past, this area has been heavily traded by big buyers. If these buyers are still waiting here and continue their buying, the price will find support at this level and react upwards. However, the important thing to note here is how the price arrives at this order block and how it reacts here. If the price falls here on a sharp selling wave and the buyers are not strong enough, the price may linger inside the order block or go sideways for a while. But if the buyers are strong enough, we are more likely to see a sharp upside reversal from here. It's important to look for an increase in volume, especially when it comes to this order block. If there is volume buying when the price hits this level, it means that big investors are back in and supporting the price to move higher. However, if the volume remains low and the price continues to press this area, there is a risk of a downside breakout, and the price has not received any reaction from the order block yet. When the price comes to the bullish order block, it will receive a reaction for the first time. so it is more likely to receive a reaction. Another important level on the chart is the bearish order block at the top. Since order blocks are areas where big players trade heavily, the price usually reacts sharply when it hits these levels. At the moment, the price is still below the falling trend line and has yet to break the trend clearly. However, if the price manages to break the falling trend line on volume, one of the most important resistance points will be this bearish order block at the top. This is because if the price gains some upward momentum, it is quite possible that it will face some selling pressure when it comes back to this area where selling pressure has occurred in the past. This is because previously, when this level was reached, large sell orders were activated and the price was pressured downwards. If the sellers in this area are still active and sell with strong enough orders to counter the buyers coming here, the price may get stuck in this order block, or make a downward correction. However, the critical point here is how this zone is approached. If the price rises with strong volume support after breaking the downtrend line and buyers dominate, an upside breakout may occur after moving sideways for a while at the bearish order block level. And it should also give a retest after breaking the downtrend so that it can bounce well when it attacks. When we look at the RSI indicator, an important resistance zone stands out. This resistance level is a critical zone that has limited the rise of the price many times in the past, and when the RSI reaches it, it retreats. Each time the RSI reached this level, sellers stepped in, putting some pressure on the market and limiting the upward movement of the price. As of now, the RSI is again very close to this resistance level. When we analyze the historical data, we see that when the RSI reaches this level, it mostly faces selling pressure. If there is a rejection in this area again, the price may move sideways for a while or make a downward correction. However, this time, if the RSI moves with strong momentum and breaks this resistance, an important signal for bullishness will be generated. One of the most important things to watch out for at this point is the momentum with which the RSI breaks the resistance. If the RSI breaks this level with volume and a strong rise, this will be a positive signal for the price and could trigger a bullish move. This is because the RSI moving towards the oversold or overbought zones is usually a factor that supports price movements. On the other hand, if the RSI loses strength and weakly rises while trying to break the resistance, then the breakout may fail, and a decline may be seen again. Observing how the RSI reacts at this level will give us clues about the direction of the price. If the RSI breaks above the resistance and stays there, it becomes more likely that the price will enter an uptrend and thus break the downtrend, and we will see a nice rise in the price. When we look at the vortex indicator, the position of the blue and red lines relative to each other gives us important clues about the direction of the trend. On the vortex indicator, when the blue line is on top, it is bullish, and when the red line is on top, it is bearish. Currently, we can see that the blue line has just crossed up. This could be an important signal that a change in the trend has started, because previously the red line was on top, indicating that the market was bearish. But now, with the blue line crossing up, we are getting the signal that a bullish move may begin. But the important thing here is how strong this crossover is, and how sustainable it is. If the blue line continues its upward movement and moves significantly away from the red line, this could indicate that the uptrend is gaining strength. Usually, such a move is accompanied by an upward acceleration of the price. That is, as the price moves up, the blue line may move higher and the red line may continue to move lower. However, how long this crossover lasts is also an important factor. If the blue line remains weak after crossing up and the red line starts moving up again, then we can say that the uptrend may be a short-term move and the market is still uncertain. Therefore, it is necessary to keep a close eye on how the price and the indicator are moving. But when the blue line moves to the upper side, it means the start of an uptrend. The higher the line goes, the higher the uptrend. Looking at the 200 EMA, we see that price has been below this important moving average for a long period of time. The 200-day exponential moving average is a very critical indicator in determining trend direction. It usually indicates that if the price is below this level, the downtrend continues, while if it moves above it, the uptrend may gain strength. Currently, the price is hovering below the 200 EMA, and although it has approached this level several times, it has yet to make a sustained move above it. This suggests that bearish pressure is still present in the market, and buyers are not strong enough. However, if the price approaches the 200 EMA level again and makes a strong breakout, then the bullish prospects could get stronger. For this to happen, the price first needs to break the 200 EMA on volume and sustain above this level. This is because sometimes the price can move above the 200 EMA and then move back below it shortly after. Such movements are often called fakeouts and can be misleading. So, it's important to see a few candle closes above the 200 EMA to see if the price is really making an upside breakout. And when the price breaks above the 200 EMA, we may see a long-term bullish breakout. Yes, friends, I hope you liked the video. If you subscribe to my channel and like that video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.